Welcome to Factful Finance, where we break down the barriers to your financial success, one step at a time. Now, if you're a woman who's been feeling the weight of debt, juggling student loans, credit cards, and maybe even a mortgage or car loan, you're not alone. In fact, did you know that the average woman carries more than $30,000 in debt? But don't worry, today we're diving into how you can tackle that burden step by step and start climbing your way to financial freedom. Before we dive in, a quick reminder. This video is for educational purposes only, and while we're sharing helpful tips and tools, it's always a good idea to consult a professional for personalized advice. So let's get started with understanding how to navigate debt and pay off loans, especially as women, and how we can harness our financial strength to rise above the challenges. First, we need to understand the difference between good debt and bad debt. It's crucial to know what you're dealing with when it comes to loans. Good debt is the kind that can help you build wealth in the long term, like a mortgage or student loans that increase your earning potential. Bad debt? That's usually high-interest credit cards or personal loans that don't contribute to your financial future. For example, let's take Isabella. She's carrying a hefty student loan bill, but knows that paying it off will increase her earning potential in the long run. That's a case of good debt. On the flip side, if Isabella is also carrying a high balance on her credit card, that's bad debt. Credit cards often come with high interest, which means the longer you hold on to them, the more you pay, and not in a good way. Now that we understand the types of debt, let's talk about creating a repayment plan. One effective method is the debt snowball. This strategy is simple but powerful. Pay off your smallest debt first, then move to the next one, and so on. It's motivating because as you eliminate each debt, you gain momentum. Imagine Harper, who has 3 debts, a $500 credit card balance, a $2,000 personal loan, and $10,000 in student loans. She tackles the $500 credit card debt first, and once that's gone, she rolls that payment into the next debt, and the snowball keeps rolling. Another method is the debt avalanche, which focuses on paying off high-interest debt first. So if you have a credit card with a 20% interest rate and a student loan with a 4% rate, the avalanche method says knock out that high-interest credit card balance first, then move on to the next. Next up, let's talk about managing student loans, a huge concern for so many women today. Many federal student loans offer various repayment plans. One of the most popular is income-driven repayment, which tailors your monthly payment to your income and family size. And for those of you who are in a position to make progress faster, refinancing or consolidating can help lower your interest rates. Just be sure you're not losing out on any federal loan protections before you go that route. And then there's credit card debt. The key here is to reduce interest rates. A balance transfer to a credit card with a 0% APR for an introductory period might sound like a trick, but if used wisely, it can save you a ton on interest. Just remember, don't spend on that card again. It's not a free pass to swipe away. Women, on average, carry more credit card debt than men, but the silver lining is that you're not stuck in a never-ending cycle. There are steps you can take right now to get ahead. But if you're thinking, I can barely pay the bills, let alone get ahead of my debt, don't worry. That's exactly why budgeting is so important. Tracking your income, expenses, and putting together a plan can help you free up the money you need to focus on paying down those loans. Here's an example. Emma, a single mom, manages to pay off $5,000 of her credit card debt in 1 year by using the 50-30-20 rule. She dedicates 20% of her income to paying off debt, 50% to essential expenses, and 30% to her wants. By sticking to a strict budget and cutting out some of her wants, she made serious progress in no time. Lastly, let's talk about maintaining a good credit score. Managing your debt is vital to this. A higher credit score means better rates on loans and better terms for things like mortgages or car loans. Here's how you can improve it. Pay bills on time, keep your credit utilization low, and regularly check your credit report for errors. As we wrap up, remember, your financial journey is unique, and while debt can feel overwhelming, there are multiple strategies to overcome it. Whether you're using the debt snowball or avalanche, setting up a budget or leveraging student loan forgiveness options, take it one step at a time. The key is persistence and consistency. So, what's the first step you'll take toward paying down your debt and taking control of your finances? Let me know in the comments. And if you found this video helpful, please give it a thumbs up, subscribe to our channel, and hit the bell so you don't miss out on more practical advice to reach your financial goals. Thank you for watching Factful Finance. Together, we'll make those financial dreams a reality.